movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, investors definitely split on whether the Fed will go for a jumbo-sized rate cut later this month after the latest U.S. payrolls report. Well, we've heard from the Fed's Chris Waller and U.S. Treasury Secretary Janet Yellen.
Data we have received in the past 3 days indicates to me that the labor market is continuing to soften but not deteriorate. And this judgment is important for our upcoming decision on monetary policy. With inflation and employment near our longer-run goals and the labor market moderating, it is likely that a series of reductions will be appropriate.
When you think about what will drive it, the pace of consumer spending, that's important, and that remains quite solid. We're not seeing layoffs. We're seeing less frenzy in terms of hiring and job openings, but we're not seeing meaningful layoffs. Unemployment insurance claims remain at very low levels. So I'm attentive to downside risk now on the employment side, but what I think we're seeing and hope we will continue to see is a good, solid economy.
Well, let's get straight to Nannette Hechler-fayd'herbe, Chief Investment Officer for EMEA, and, of course, Head of Investment Strategy, Sustainability and Research at Lombard, Odier, joining us from Zurich. Nannette, great to have you on the program. As always, it's a huge week for the markets. We had that repricing because of Fed expectations. We're expecting the ECB. What are you most excited about in markets right now?
I think it will be all about the 25 basis points versus 50 basis points rate cut by the Federal Reserve. I think this is really the focus now. Inflation is well on track to the long-term objective, 10-year U.S. break-even inflation rate at 2%. So I think the market can fully concentrate on what is the real economy doing and on the Fed doing perhaps an insurance cut here to get ahead of the curve again.
So, Nannette, I guess the question which will be contentious is do they front load the cuts or do they actually go step by step? What's your take?
I think they don't have much to lose to actually make a bigger cut in September with a 50 basis points. First of all, there has been shifting expectations in this area. Certainly, the market would not be overly surprised, and it's a great possibility for them just to initiate an insurance against whatever softer data are coming that the Fed is already focused on it. So. Although things are standing really quite close in this 25 scenario versus 50, but we are leaning now towards a 50 basis points cut, front loading in September, followed by more 0.25% cuts in November and December.
Nannette, what does it, when you look at China and some of the concerns, of course, of deflation, we're seeing iron ore also weakening. Do you worry about a global recession? And again, what does that mean for your portfolio positioning?
No, at this moment, we are still of the view that a recession has a low likelihood. Yes, we are completely in a soft landing scenario. Manufacturing has been very soft for the whole of the year, and China is playing a very big role in manufacturing still. So altogether, it's an environment where we are seeing central banks able to provide the support, the backstop for the global economy not to enter recession. These cuts in interest rates by developed market banks are going to be helpful to stabilize the real economy, and that should provide still for a good balanced strategy, Francine, by way of investment. It provides a good backdrop for bonds where bond prices can continue to stay stable as central banks are cutting interest rates and inflation is stable. And then as far as valuation of equities are concerned, of course, rate cuts are helpful as well. So a good balanced strategy that is mixing fixed income equities, but not forgetting the alternative investments that have played the stabilizing, diversifying role all along this year.
So, Nannette, when you look at, for example, the falling oil price, what does that mean for the global economy? Is it a kind of stimulus for it, or do you worry that it's a sign of uglier things to come?
As far as commodities are concerned, for sure, there is always this aspect of cyclical commodities and those metals, for example, that participate in manufacturing value chains are signaling to us that there is a softer economic outlook that is unfolding. But on the other hand, commodities are also responsive to geopolitical risks, are also very much, when you think about precious metals, an area of safe haven. I think commodities right now are playing an integral part of allocations for sure. We have been very positive on precious metals and gold in particular in the current context. It is benefiting from the cyclical setup that I have described, inflation that is stable and rate cuts. It is also a safe haven in case of risks flaming up again. And it's a perfect diversifier, not being very correlated with other assets in typical asset allocation.
Nannette, we also had on Saturday this pitch from Donald Trump that basically said if you abandon the dollar, if you hurt the dollar, watch out, I'm putting tariffs by 100% on you. I mean, this is another phase or another way of looking at what he could do. How do you, I guess, differentiate the noise from the actual policy when it comes to the U.S. economy?
I think, generally speaking, policy action and actually political action has taken much more of a center stage, Francine. In the past, it's been all about the economy, all about central bankers. Well, today, in today's world, it's all about politics. And so what I am taking out of it is for sure some uncertainty about inflation in function of the U.S. election outcome. There are two different scenarios that we are currently able to draw, depending on whether it is Kamala Harris or Donald Trump that are getting into the White House. And that is going to imply also different paths in terms of how rapid and how much the Federal Reserve can do, with all the implications for the dollar for cyclical reasons. So I think that right now we all have to learn to factor in much more political influence that is leading to more uncertainty on inflation. And therefore, in terms of the positioning that investors have to do, there is also risk scenarios that have to play a much bigger role. As far as the dollar and the de-dollarization is concerned in those comments you referred to from Donald Trump, I think the move towards having different alternatives from a number of countries in the emerging markets, also in central banks, in terms of their asset allocations, are probably going to see a decline of U.S. dollar assets. This is not the first time that we had such declines in shares of reserves, central bank reserves of dollar assets. You can go back to previous periods where there has been fiscal policy, current account deficits in the U.S. that have exactly led to the same thing. So I think that in the end, whether it's central banks or investors, when they think about the U.S. dollar and the outlook for it, will be very sensitive to the sustainability of economic policy in the U.S.
Nannette, thank you, as always, for joining us. Nannette Hechler-fayd'herbe from Lombard Odier. Now, coming up, don't miss our conversation on commodities and the energy transition with Jeff Currie, Chief Strategy Officer for Energy Pathways at Carlyle. More on that next, and this is Bloomberg. ore futures briefly sank below $90 a ton earlier as China growth concerns weigh heavily on the market. Now, to talk more about the outlook for commodities, Jeff Currie, Chief Strategy Officer at Energy Pathways at Carlyle. Jeff, as always, thank you so much for joining us. I have 1,000,001 question on commodities. Oil also a little bit down. If you look at the falling price of oil and other commodities, what does that mean for the global economy?
Well, it's clearly positive. The question is, what is this fall in prices signaling? I want to emphasize in oil, the fundamental physical picture is still intact. Inventories are drawing. You saw it in last week's data, the satellite data, they're drawing. You're in a deficit. Forward curve is backwardated. The financial market, however, is where the bearishness is. And it's trading the forward outlook, not today. So we look at this decline in prices, it's telling you nothing about the current situation, but rather what it's telling you about is the future situation. And they expect weakness in China to dominate. I'm not trying to say China's okay today. It's weak, but it's not impacting the oil market that significantly right now. The second thing is OPEC, spare capacity. And the third is U.S. shale. Those are the three factors that are driving the weakness today. I give credence to the Chinese concern, but the other two, I think they're overblown.
So, Jeff, this is basically a sign of mounting weakness in the global economy. It's not some sort of stimulus that could lift up the economy.
Well, I think, it's not that large of a pullback. Let's say, low 80s to low 70s. It helps at the margin, but it's not significant. I think ultimately what it's reflecting across the board is concerns around China. And I want to emphasize, yes, China is weak right now, but the market response is overblown. So let's talk a little bit about China and what's going on there. Let's start with the energy market. The year-over-year declines have a lot to do with base effects. If you recall, last year, China came roaring out of COVID. You had a lot of restocking going on. That pushed the demand level up substantially during third quarter last year. This time around, you have destocking going on, and the level is going down. So the gap, the year-over-year declines are quite large, 500,000 barrels per day, and that's what has the market worried. When we think about that decline, 1/3 of it is associated with energy transition, like trucks shifting out of diesel into LNG. This 2/3 of it is associated with economic weakness. And that's the one I think people are concerned about and focused on. We think it's temporary as you go into fourth quarter, and we expect it to see a lot of it is base effects. It just gets easier on the comp. But the monthly data is showing a turn. I also want to point out another thing that's driving that weakness is the rate differential between the U.S. and China. China's been cutting. U.S. has stayed at the very high levels. That pulls capital out. The last quarter's capital outflow was a minus 14.8 billion. That's a very large number for China. And I always said the best way to get around capital controls is use commodities to move them out.
But, Jeff, so first of all, have you written off China as a solid, demand center for oil? And because of the transition, there must be others that actually benefit, like copper and iron ore. And when do you see that picking up significantly?
I think, first of all, when we think about China, to answer that, China's much smaller in the oil market than it is in the metals market. It's much larger. And strong growth out of India is offsetting some of this weakness in China when you look at it at a global basis. But turning to the metals market, what had been going on previously is that we had a weak property market, and that has remained weak now for about 2.5 years, being offset by strength in manufacturing driven by green capex goods. And as long as the property market could stabilize, the strength in the green capex goods offsets that weakness in the property market. What has happened recently is concerns around tariffs hitting those green capex goods and slowing it down, while the property market has started to sink again, not offsetting it. And that's what's created the concerns, particularly in copper. By the way, I want to give you some numbers on green capex capacity. The auto market in China is about a 25 million unit market. The capacity to produce cars in China is 50 million. So you see the concerns about, the exports of EVs, lithium batteries and other green capex goods. But I think the key point there is that balancing act between the property market that's hurting copper, and then you have the offset being the green capex. The question right now is, can they stabilize that property market?
Jeff, are you still confident about a price spike for oil after this unwinds?
Well, the question is, the spike was under a condition if you saw a disorderly unwind of all of these shorts. Here in APEC, here in Singapore, the willingness of anybody to short, they go, let's go short this market because it's bearish forward fundamentals. But the reality, everybody puts the caveat warning sign. This market is at a record short, shortest on record, which means it's very dangerous to short. And the point here is we have destocked inventories because of high interest rate. The capital cost is too high to hold the inventory, so you run it down. You think about financial positions as being working inventory in the financial market. High interest rates, we run down those positions to very low levels. What the point I'd argue is interest rates start to decline. Most likely you'll get an orderly unwind of those shorts, and we'll have some restocking going on. The spike is something happens that shakes everything out of the market, that you get that disorderly unwind of all that shorts. That's where you could get the spike. So I know it's not like a mainline forecast. It's just saying, hey, we got to be very careful with this record level of shorts in the oil market today.
Yeah. But Jeff, do you see record amount of shorts in equities overall? And what does that mean, for example, for futures to iron ore, or how we look at the world economy?
Well, when we look at the equities, they've come off very, very sharply. And, the question you have to ask is, are they going to cut dividends that they pay to the investor, or are they going to cut capex? They're most likely going to cut capex before they cut the dividend, because they have to continue to attract investors into the space, which means this pullback, even though it's not physical yet, it is starting to potentially impact capex budgets, which will again put more pressure on that forward. Because remember, the bull thesis that we're putting forth is really driven by underinvestment in the need for large-scale capital investment to make the energy transition happen.
Jeff, in one answer, what's the commodity that's actually being sold off unfairly? Where do you see the most opportunity?
The most opportunity goes back to gold. It's a winner across the board here. Gold is is what the Chinese property owners are buying as a hedge against the weakness in their property market. Gold does well with rate cuts that are likely to come up. Gold does well when you have economic uncertainty. So it's kind of the catch-all of all these markets. And then I think, when we look at, longer term, copper is the one that has the stronger fundamentals further out. Yep. Gold is going to be, or oil has a lot of volatility.
Jeff, thank you so much. You'll have to come to the studio next time. Jeff Currie, Chief Strategy Officer at Energy
Thanks,
Pathways
Francine.
at Carlyle.
Great.
Much more to come. This is Bloomberg. Boeing and its largest union say they've reached a deal to potentially avoid a strike at the troubled U.S. aircraft maker. Now, the offer includes a 25% wage increase over 4 years and a commitment to build Boeing's next plane in Seattle. You can see Boeing pre-market 2.9% higher. And we'll also bring you live pictures of Bloomberg's Spotlight on ASEAN business event taking place in Singapore. You can continue watching that on Live Go. Bill Winters there with our Haslinda Amin. This is Bloomberg. Good morning, everyone. Welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. STOXX stage a partial recovery after last week's sell-off as cooling U.S. jobs data adds to fears that the Fed is behind the curve on rate cuts. Deflation risks grow in China. Signs of economic weakness mount. Consumer prices rise less than expected as weak demand threatens Beijing's annual growth target. Plus, Donald Trump threatens a 100% tariff on countries that turn away from dollar, while Trump now leads Kamala Harris by a point in a new national poll. So in other news, Mario Draghi is set to deliver his long-awaited report on European competitiveness in the next half an hour. Now, the former ECB chief is expected to sound the alarm over the risk of the EU's economic decline. Well, joining us now is Jamie Rush from Bloomberg Economics. So, Jamie, thank you so much for joining us. What exactly are you expecting him to say?
Well, I mean, I think he's going to... There's lots of things for him to say. I mean, there's lots of problems, right?
Yeah.
So, I mean, if you think about the risks, well, actually, they're actually a fact of life. Like we've seen the EU economy has grown much more slowly than the American economy over the past 2 decades. And if you think back to 2003, when the last competitiveness report was published, the conclusion was that Europe was in a rut. Europe's still in a rut. So I think we have... The question is going to be around the solutions that he proposes and whether they're feasible. And I think there's probably like 2 groups of solutions, right? There's things that cost money, and we could talk about those, but they're probably not really a goer because there's no money. And then there's things that don't cost money, like, say, completing the capital markets union, completing the banking union, things that could actually help. But they cost something that's even more precious than money. They cost political capital. And there isn't any of that either. So I think we're serious constraints both on the fiscal side, also on the political side, because some of the champions of EU integration, like Macron, have waned.
So, Jay, I want to ask you, what's the point of the report? It kind of lays out all the troubles that Europe has, but if there's no willingness, if there's no money to actually get anything done, does it actually, I guess, kickstart anything?
Well, I think it's going to come up with some useful ideas. I don't think that every single recommendation in the Draghi report is going to be followed, because it's just, as I said, the constraints are just too big, too binding. But little inroads can be made in different places, right? And so I think if there's anything that's taken from some of this report, then I think it's going to be nudging Europe further down the road towards prosperity. But we're not looking at a wholesale change here, and that's going to be a problem.
Jamie, we're also expecting, of course, the ECB on Thursday. This is a week before the Fed. What's changed since their last cut in June?
Well, I mean, quite a lot, really. So, I mean, first of all, the Fed has obviously decided that now is the time. Yep. And so this obviously makes a lot more space for the ECB to cut without worrying about the exchange rate, without worrying about the going-it-alone effect on the all important issues. But the other thing that's changed is that there's just much more evidence now of widespread sort of deflation or disinflation. So we got the wages, like compensation of employees data last week. That dropped to 4.3% on the year. ECB was forecasting 5.1% as recently as June. So that's like actually a big undershoot in wage growth. So they can feel pretty confident that domestic price pressure is falling away. Also, profits data, they're showing a bit of an easing in profit margins as well. So all good news. All should cement a cut. The question really is how fast they're going to cut thereafter, and the jury's still out. And
Jamie, when do we start modelling? I mean, we had this, I guess, campaigning pledge from Donald Trump on Saturday saying that tariffs will be at 100% if you try and challenge the dollar. What does that mean for Europe?
Well, there are just big questions around trade policy, right, for Europe. I mean, Europe is now trying to deal with its legacy issues as well as confronting the geopolitical context it's now in. So it's got a doubly hard challenge. Tariffs. I mean, the main thing is that Europe is not in a position to follow the US on tariffs because it's so much more exposed to China. And so we're going to have this like political conflict or geopolitical conflict that's going to continue, and Europe's going to have to navigate that path, and it's going to be hard.
Jamie, thanks so much. Jamie Rush there from Bloomberg Economics. Meanwhile, the French government has requested an extension from the European Commission to the deadline for submitting its plan to reduce the public deficit. Well, the finance ministry told Bloomberg it asked for additional time to ensure consistency with its 2025 finance bill without saying what the new proposed deadline would be. Venezuelan opposition leader Edmundo Gonzalez has been granted political asylum in Spain after fleeing his homeland to avoid arrest. Well, it comes a month after the opposition presented voting records they say prove Gonzalez won the July presidential election. And 2 NATO members reported incidents involving Russian drones over the weekend as Moscow steps up its missile and drone barrages against Ukraine. Latvia's president said a Russian military drone crashed in the eastern part of the country on Saturday. Meanwhile, Romania's foreign minister urged Russia to abide by international rule after a drone violated its airspace over the weekend. Coming up, the UK needs some huge investment to get back on track. That's the finding of a new report. We'll be speaking to Nigel Wilson, who chairs a group that authored the report. He's also former Legal and General Chief Executive. That's next, and this is Bloomberg. Back, everyone. Now, new report says the UK needs around £1 trillion of investment over the next decade in order to boost growth. Now, according to the Capital Markets Industry Task Force, an extra £100 billion of fresh investments every year would put the country on track to achieve 3% annual growth. Now, the report's chair, Nigel Wilson, is with us now. He's also chairman of the Canary Wharf Group and former chief executive of Legal and General. Nigel, as always, thank you so much for giving us a little bit of your busy schedule. So first of all, 3% target. Is there a gold spot with the 3% growth target?
Yeah, it's consistent. I mean, we're 100 billion is about 3% of GDP, so that would you get that instant boost to GDP as a consequence of that, and it puts us back in the middle of the pack. We've been bottom of the division for G7 in most years for the last 20 years, and we're at 17 to 18% when we need to be at 21, 22%, and 3% is a good, easy to deliver number on both the supply side, the demand side, and on the relative side.
So why have we been bottom of the pack? Is it political will? Is it the fact that actually it was just a struggle to attract investment? Is it that the story wasn't cohesive enough?
No, I think we've just underinvested. And if I just take a typical industry like water, do we think we've overinvested? We've underinvested, so we've got to catch up, and whether that's 8 billion or 10 billion pounds per annum. That's, I've been on housing and talked about that a lot. Energy, we know we're behind on that. And we have great industries like VC and private equity, to be honest. We probably have the best private equity industry in the world, alongside the Americans. And we're second with VC. We have more VC money here, and that's grown by a factor of 10 in the last 10 years. But I think it can grow again over the next 10 years, because we have the best fintech firms in the world. They're private at the moment, but eventually they'll become public, and they need more capital. They can invest that capital because they're great firms. A lot of that capital now comes from America, but we can have more of it from the UK.
So what's in your report? And actually, on water, is there something like Thames Water that actually makes investors really scared about what they'll find in the UK? This is like a big scandal.
Well, they are scandals, but they're because of underinvestment over a long period of time, and they eventually catch up on you. I've talked before about the Gordon Brown's dividend tax in 1997. Roll forward 25 years, amount of equities we hold 50% at the start of the process, the finish 4%. That made a huge contribution towards these things. But any individual year, it looks like a difficult decision and doesn't happen as a consequence of that. But we've got 6 trillion of capital that could be invested. A lot of that's held, and we're too much of it, in gilts and in cash. We need to have that productive investment coming from all of that. And over the long term, that should lead to great results, because, if you remember, from 1955 to 2005, the UK's productivity growth, real wage growth, real per capita income growth was the same as America. In fact, our stock exchange outperformed America for 50 years.
Nigel, it's not easy, right? Taking money out of gilts and putting it's just a riskier strategy.
It's not a riskier strategy. That's the myth.
It has to be a riskier strategy.
No, it isn't a riskier strategy, because the 10 and 20-year VAR is much less. The risk return over 20 years in the UK and indeed in the US, over any 20-year period, and you're making those investments for 20 years, you have had a positive real return, and a substantial one. Not one of those years is it negative. In gilts or cash, for a large part, you get negative returns on a real. But
election cycles are not over 20 years.
No,
so
that is part of the problem. But that's the theoretical horizon is the 20 years. So you should be looking at 20-year variances, not one year or 6 months or whatever. And it's, Buffett's done this for a very long period, taking very long-term views, invested for a very long period of time. And that's delivers a much better outcome for consumers.
Is this government ready to spend political capital on this?
They say they are, but they have to deliver on that. And I think certainly the meetings I've had in the past with Keir and Rachel and Johnny and others have been very pro-business. But if you look what has happened to AstraZeneca, they've had one plant, they couldn't get finance in the UK, they've done it in Ireland. The next one they're struggling over. Shell have just been told that they can't invest in a North Sea oil project. And they're our two biggest companies. And we should be looking at them and treasuring them and trying to help them become even more successful going forward.
Global Investment Summit is October 14th, and we've already heard that a lot of Wall Street giants who have the firepower to put money in this country can't make it. Does that count for something? When you speak to chief executives around the world, are they willing to put money in the UK?
No, they're willing to put money in the UK, and look at Microsoft, look at Google, and look at these other places. However, it's a very odd time to have the Global Investment Summit 2 weeks before the budget, and personally, I would put it back until early in the new year. It's one of those diary slots that's not in people's diaries. And so if you want to put it in people's diaries, you want to create a real positive message in the UK, have the summit later and get a really good narrative, because people are going to be really interested what's in the budget, what tax changes and the whole conference will be, oh, look at so-and-so, a lot of American executives won't come. And a lot of global investors, they won't come. And so...
Nigel, how difficult do you think this budget is?
What?
How difficult do you think this budget is?
I don't think it's difficult at all. In fact, I think the UK economy is growing, reasonably well. Unemployment's, at a very low level. Inflation's come down to nothing. We've got this huge investment gap. And that's what we should be focusing on. Not the negative stuff, that there's some black hole or whatever. Let's talk about the fact that we're fighting fit and becoming increasingly fighting fit. London's still a great city. Look at this wonderful place that you have here. And there's huge investment opportunities right now everywhere in the UK. But you be the people who open the doors, the politicians. We don't need any more, government banks and this, that and the other. We need the big investors in the world to come to the UK to invest and deliver growth for our people.
But, Nigel, so the Prime Minister was definitely downplaying the economy, which is quite strong, stronger than expected, and certainly stronger than a lot of other G7 countries. Yeah. Why is he downplaying it?
I don't know why he's downplaying it.
But is it politics to put the blame, or could there be something, game-changing in the budget that he's trying to explain today?
Not that I'm aware of. Okay. So, but certainly my pre-election discussions with them. In fact, we hosted two meetings when I was at Legal & General that Keir and I had engaged on, one on infrastructure and one on housing, where the chairman or the chief executives of all of the firms that we invited came. So 100% attendance from even the big global players who came, because they wanted to listen to the narrative, tell their story around it. And there was, I would say, excellent active listening from the Labour representatives pre the election. Now they have to deliver on that post the election and be open to business to the big providers of capital and the biggest and most successful companies, plus all our growth companies. Our growth companies are to be treasured because we have some of the best growth companies in the world, in the UK, in growth areas.
But they may not IPO here. They may IPO elsewhere because the capital markets pool is bigger.
And that's part of our job, and part of is how do we make it easy for these people to, and reversing the outflows into active equity for the last 20-25 years in the UK, and making a much more attractive place to invest. And I'm going to be a man on a mission on this for quite some time, because I think it'll take a lot of time to persuade people. This is an Indiana Jones moment. Actually, we've got to throw out the stones, we've got to walk across, we've got to make ourselves a growth economy, because we've had no growth in real wages, real productivity or real GDP since the financial crisis, and so we've fallen massively behind America. It's no good comparing ourselves with Europe. They're already recognising they've got a bigger problem.
Nigel, would you force, for example, pension funds, maybe even local authorities, to put pension money in UK companies?
Yeah, I would be much... I call it soft compulsion. but
does anything get done with soft?
They've got 38% of their assets invested in global equity in the MSCI. We managed a lot of those assets in my previous life, so I know where they are. I know where they are and what they did with it. And the MSCI is going to look good on any backward-looking metric, because it's 70% of it's the US. Two companies, Apple and Microsoft, have a bigger weighting in the MSCI than the whole of the FTSE 100. And that tells you've got to start thinking bigger and bolder. Yeah. There's one message to the Labour Party.
But Apple would have given you better returns.
Apple did give better returns.
So that's why you invest in that and maybe not the FTSE.
That's what's happened for 25 years, because, if you look at since the financial crisis, the US index, US has delivered 8.4% real growth per annum, and we've done 2.2. The previous 50 years, we were 6.6, and America was 6.2. So we were doing better. Now we're doing worse. Doing the same stuff isn't going to deliver anything else different from what we've done in the past. Discouraging investors from coming to our global investment is not a great idea.
And Labour understand this?
They're beginning to get it, because actually people were looking for hope after the election, not doom and gloom.
Nigel, as always, thank you so much for joining us. What a good conversation. Nigel Wilson, chair of the Capital Markets of Tomorrow report. Now, coming up, Apple. We're just talking about Apple. Apple is set to unveil its new AI-focused iPhone 16, which it hopes will be a smarter phone than the rest. We'll give you all of the details next. This is Bloomberg. Everyone, now in a moment we'll talk Apple with Matt Bloxham from Bloomberg Intelligence, but first let's get the latest on U.S. politics. And Donald Trump has pledged to make it too costly for countries to shift away from using the U.S. dollar, adding a new pillar to his tariff platform. Now joining us now is Bloomberg's EMEA news editor Rosalind Matheson. So Ros, thank you for joining us. I mean, it was a little bit of a wild card when he said that on Saturday. What countries might Trump be targeting on these tariffs?
Well, it seems he's really aiming this at the countries that are being in the BRICS grouping, which is obviously China, as well as India and others, and this grouping which is increasingly expanding to bring in new members and trying to establish itself as a slight alternative power grouping in a way to the Western-led structure from the US. And so what you have is an expanding power base with BRICS, countries in the Middle East, in Africa, elsewhere, possibly Southeast Asia joining, and the idea of can you then move away from the US dollar as a key currency for trading? Can you use the yuan more, for example, which is something China has long wanted to do? And so this is really about saying to those countries, I'm going to compel you to continue to try and use the US dollar, because otherwise I'm going to put 100% tariffs on your products.
But Ross, this seems dangerous because already, this big move got accelerated when there was, the sanctions against Russia, where suddenly a lot of actors said, well, we don't want that to happen to us. So by, threatening, is it counterproductive?
Well, obviously, if you take a trade action against a country, that country will probably take a trade action back to you. We've seen that with China as well. So you've got US probes about China on the dumping side, and then China retaliates against Europe with a counter probe or counter tariff. Similarly, again, China and Canada recently. So if you take an action like that, 100% tariffs, even if that's feasible from the outset, you're going to get a response. So all you're doing is creating a further environment where we're in a global trade war at some point. And what does that mean for the US in turn? Because you can say that you're going to do that on all your goods coming in, but what does that do to your goods going out? What does that do to the global trading system as we know it? And what does it do to the dollar in turn? Does it actually do for the dollar what Donald Trump would hope it would do?
And Roz, what do the polls tell us between Kamala Harris and Donald Trump?
Well, it's very interesting because we had a poll out over the weekend indicating that Donald Trump is ahead of Kamala Harris. But all of these polls in recent weeks have been within the margin of error of around 3 points. And, she did get an initial bump, it seems, when she became the candidate, a bit of momentum behind her, Joe Biden moving out of the way. Is some of that fading a little bit naturally after the initial kind of sense of excitement over that? We're going to see the debate really focus potentially on the economy, and that's where he does seem to poll better. She's a bit of an unknown when it comes to economic policy. She's starting to roll that out now, but obviously there are questions about what her economic policies would be. And so these polls are showing a little bit of uncertainty around that, but they're all, again, within the margin of error, just showing that this race is incredibly tight.
Yeah, and then the big debate, of course, is tomorrow night, September 10th. Ross, thank you so much, Rosalind Matheson. Now, it's also today a big day for Apple with the iPhone 16, the tech giant's first AI-focused smartphone, being unveiled later today. Now, Apple is also the focus of our Big Take, which looks at its rise to become the world's most valuable company. So let's bring in Matthew Bloxham. He's senior technology analyst at Bloomberg Intelligence. Thank you for joining us, Matt. I mean, the Apple 16, is it going to trigger people kind of rushing to get the new version, or is it just another rollout?
I think it's probably going to be more of just another rollout. I think certainly back in June when they first announced the Apple Intelligence features, there was a lot of excitement. This was going to trigger a super cycle. I think there is a lot of pent-up demand out there, but what we've seen subsequently is a lot of these AI features are going to be drip-fed into the market, and a lot of the more substantial ones won't come until next year. So I think probably today's announcement is going to be a lot about the promise and potential of what this device is ultimately going to be able to deliver, but maybe the kind of fact that a lot of these kind of more exciting features won't come for a while may kind of hold people back a bit in terms of when they hit the buy button.
So Matt, what could we see in it? And again, I guess my gut feeling would be, let me wait for the second or third version because it improves. It just feels a little bit too soon to go out there and buy it. Yeah,
I think it's going to look very much like the iPhone 15. Probably the biggest difference is physically are going to be a couple of new buttons. So there's the action button, which is already on a couple of the 15s, but all of them, and then this capture button, which is a bit like having, like when you kind of take a picture on a camera, it'd be a kind of quite clever and sensitive phone that allows you to kind of autofocus and move things and zoom in and out. So a couple of interesting physical features there. The rest of it's about the kind of the software upgrades. There's going to be a new version of Siri, which is going to be quite a big focus around the event, I think. And I'd say then beyond that, the promise of the AI features over the next months.
Yeah. What are the biggest threats to Apple going forward?
I think there's a couple really. I think the most pressing, and we see it already, is the fact it's so big now that it's kind of under pressure to kind of break up, and the kind of value of their kind of integrated ecosystem under pressure. So they've got to navigate that carefully. I think beyond the immediate term, they'll see it's what comes after the smartphone eventually, and are they savvy enough to actually kind of be the leading player in whatever that new technology is.
Matt, thank you so much. As always, Matt Bloxham there from Bloomberg Intelligence. Coming up, we have a lot of things coming up today and tomorrow. We also have an exclusive interview with Pascal Soriot, the Chief Executive Officer of AstraZeneca. That's an exclusive at 9:10 a.m. UK time tomorrow. Up next, it's Bloomberg Brief, and this is Bloomberg.